Hi, everybody. This is Josh Jelinski, the financial quarterback, here with one of my all-time favorite guests, tax strategist, rich dad, accountant, Tom Wheelwright, an all-around, genius on all things tax. Maybe one of the smartest guys we have on taxes every year. I always look forward to having you on. But Tom, for those who've not read your latest book, you're a best-selling author. Talk about your background and what brought you into the field of accounting.
Yeah, sure. So I started my accounting way back when I was in high school, and I actually worked in the bookkeeping department of my father's print shop, and that's actually where I got started. And then I did my undergraduate at the University of Utah in accounting, my graduate work at the University of Texas in accounting and tax. I spent 7 years with Ernst & Young, including 3 years in the National Tax Office. I spent 4 years as the in-house tax advisor for Fortune 1000 company, 14 years as an adjunct professor in the Masters of Tax program at Arizona State University, and 25 years building, buying, selling CPA firms. And now we're running an international CPA network with about 45 CPA firms around the U.S. and Canada.
Wow, and that's called Wealthability, right?
That's Wealthability.
Wonderful. And you go on wealthability.com if you want to learn more about what Tom does for clients and people trying to save money on taxes, which is on everybody's mind. So you did an amazing YouTube I saw a few weeks ago on the new Biden proposals. Give us an update first on what has become, I guess it's not really law yet until the president signs it, but it went through both houses. And what's going on with the Biden? Is it $1.25 trillion spending? Is it 1.75? I'm losing track.
Right. So two different bills. The infrastructure bill, which President Biden is supposed to sign on Monday, didn't do a whole lot tax-wise. It's not raising a whole lot of revenue. It's just spending a lot of money. It made one change to cryptocurrency, where cryptocurrency, the exchanges are going to have to provide 1099 information to people. So that's one big change. That'll happen over the next few years. But the big, what was originally $3.5 trillion, and it's been dwindling. It's been dwindling pretty fast, Josh, and it's down to about 1.75. My guess is that they're going to dwindle up further when they come back in session on Monday, and I think it's going to be down around 1.5. And they've pretty much taken out all the really bad stuff, with a few exceptions, out of that bill, and we're left with a bit of a whimper.
But aren't there still some significantly bad things? Like, didn't they get rid of QBI if you make over $400,000? Or did I mishear that?
They were talking about it. They pulled it out. So qualified business income deduction is safe. They didn't change the estate tax exclusion. One thing that they are doing that seems like it will get in there, and that is they're going to tax partnerships and S corporations on income that's whether it's distributed or not distributed, anything over 450,000. So that is a big change, because that's about a 3.8% tax rate for people who've never had to pay that tax before. Now, I think that for the small business owner, that's probably the biggest tax change. Of course, rich people are going to have to pay that 5% surtax on $10 million and basically an 8% surtax once you hit $25 million. So there are some tax rates, but they don't affect a whole lot of people.
So what's this 5% surtax? Talk about that.
So that's a surtax on anybody making more than $10 million. Where it's really going to hit people is the year they sell their business, right? So typically a business owner sells their business, they have a one-time big capital gain, and that's going to be subject to that 5% surtax if it's over $10 million. Professional athletes, actors, actresses, people who, anybody who makes like in that $10 million range and above, they're going to pay that 5% surtax. But and certain trusts, Josh. I mean, here's an interesting one. So if you have a trust that's taxable, we call that an irrevocable or a complex trust, that 5% hits at $200,000. So if you got some trust, you've going to have to manage that income pretty closely.
Wow, and we'll talk about how you manage trust income. I'm going to write that down because that's one of those things where I meet people and they don't know how to manage trust income. So I do want to talk about that because that's a big consideration. But you know what? This just frustrates me that they're always trying to screw the small business owner. Like, so you have somebody works their way up, sells their business for whatever, $10 million. They probably weren't made of money. They probably built it like, you or I, we're entrepreneurs, self-made people. So they have to pay a 5% surtax, generally a 5% state capital gains tax,
right?
Plus the 20% federal capital gains, plus the 3.8. So what are we at? We're at
31. Well, when you can get all the way up to
33.8%.
Yep.
That just ticks me off. Plus whatever state income tax or it's just, that is screwing the small business owner. I loved how they said, we're going to tax the billionaires and the trillionaires. There's really no billionaire tax yet, is there?
No, I mean, the closest thing is that 3% surtax over 25 million. I mean, that's the only thing that they're really doing. So no, I mean, and now they're talking about bringing back the state and local tax deduction. So if they do that, actually, the millionaires will actually get a tax reduction. So they're actually going to decrease the taxes of the rich in their tax the rich and spend plan. It's pretty hilarious.
Wow. Did you get to them? I know you're in Arizona. Did you get to Kirsten Sinema? Are you like a consultant for her now?
I'm not, but I will admit I did get on to her website and I did send her a note, and she got a lot of those and she responded to them. She actually did she's done a really terrific job holding the line there in the Senate.
Wow. I mean, you wouldn't have thought that. So 33.8% tax if you're middle class selling your business. What about the 1202? We're getting a little in the weeds, but talk about Section 1202 for our listeners.
So this is a big one. This is actually a big one, Josh. So 1202 means that if you were to sell your business and you had regular stock, you're supposed to, right now you get the first $10 million is tax free, and under the current plan. Now it's not at the Senate yet, so we haven't seen the Senate version, only the House version. But the most recent House version eliminates 1202. So you would be taxed fully on that $10 million. There's no 50%. For years and years it was 50%, right? And then it went up to 100%. And under the House Ways and Means plan, it would be zero.
So more small business owners getting. So if you're selling a farm, family business for, let's say it's $2 million, you now pay tax on that according to this new bill.
Right. Family farms, typically you would have paid tax in the past, though at a much lower rate.
I misspoke.
But this is really this is really the this is the startup business. This is the business that has been built. It's an overnight success after 30 years, right? I mean, that's kind of the way those things go. You work, and all of a sudden something clicks, and now a buyer comes in. It's that small business owner that's been plowing all their money back into the company for the last 10 years that all of a sudden is going to get hit pretty hard.
And what can they do? Well, actually, that's a great pause for our first break of the hour. What can the small business owner do in light of these 1202 changes? And what can our listeners and viewers on the new YouTube channel, folks, head over, buy Tom Wheelwright's book. What's your latest book, Tom? Tax-Free Wealth?
It's tax for wealth. I have a new one coming out next year, but that one's not quite ready. We're waiting for this legislation, and then we'll get this book out.
And folks, if you want that book, we'll give it to you free. When you schedule and keep your no obligation review, call us now, 888-988-JOSH. Be sure to share our YouTube with people, hit the subscribe button, and share our podcast. We're on Spotify, iHeart, and on WOR, New York's one of New York's biggest talk radio stations and one of the biggest talk radio stations in the country. So, folks, call us now, 888-988-JOSH, and you get Tom Wheelwright's latest book, Tax-Free Wealth, when you schedule and keep your no-obligation financial consultation at 888-988-JOSH, 888-988-5674. And we're back with Tom Wheelwright talking about Section 1202, which is a little-known tax thing. Now, when you have a Section 1202, how do you avoid tax currently? Are they deemed C Corps, S Corps? How do they get
right? So now, if you own, it has to be a C corporation, and you have to have owned original stock for more than 5 years. And then when you sell it, it's just automatically tax-free up to first $10 million. So that's been a tremendous tax benefit. And, you know, when the 2017 Act was passed and we went to a 21% rate, we saw a lot of people move to S corporations. They're thinking, I'm going to take advantage of 1202. This is a great opportunity. And now it seems like they're just pulling the rug out from under them. So it's disappointing. They keep going after small business. And they're going after big business somewhat this time. They've got a 15% corporate minimum tax, which is a terrible idea, by the way, but it doesn't affect small business. They have, my view is, and Josh, we've talked about this, that, it started with the pandemic where they shut down small business and let big business stay open. And now what they're doing is they're keeping big business at 21%. And they're closing off 1202 for the small business. So it's I think it's a travesty that they keep going after the small business.
So what can we do? Obviously, so call your congressman. I mean, didn't it pass both houses? So what is it?
It is not. It is not. This is not passed yet. So right now it has not passed the House yet, and they're waiting. The moderate Democrats are waiting for the numbers. If the numbers come back really skewed, then we might not see it at all. But if you've got a Democratic senator in your state, I would contact them, because it's the senators that really have the power right now. They're the ones that really have the ability to stop this. We've seen it from Joe Manchin of West Virginia and Kirsten Sinema from Arizona. But really, anybody could. I mean. President Biden said it very well. He said, when you have only 50 Democrats in the Senate, everybody's a president. So they all get veto power. So that's a big one. I think if it does pass, I think what we're going to see is we're going to see more stock-for-stock transactions. In other words, you'll just take on the stock of the seller, and you'll just exchange. And that way you can sell their stock when you need it, and you won't have that big you won't have a big transaction, a big tax all at once.
Yeah, so call your congressman too. I mean, New Jersey in particular, where
sure.
I'm from, we have a lot of seats that go Republican, then Democrat, then, New Jersey used to have 7 Republicans and 5 Democrats, and then they had 7 Democrats and 5 Republicans, and then it, overwhelmingly, I think there's now 2 Republicans in the entire House, Jeff Van Drew and Chris Smith. But you have Andy Kim, who is a Democrat in, I believe, District 3. It's my home state, so I know all the... Josh Gottheimer, who's in a normally red district. Andy Kim's in a normally red district. Those are people that you can call, because that's how they're getting the SALT passed. Gottheimer, and a lot of those New Jersey, New York, Staten Island, certain pockets of New York where they lost, some of the Democrats lost because they never repealed, the SALT tax. They said they were going to, and some Democrats won in normally red districts because they were very ticked off. I know where we live, everybody was ticked off at losing the SALT deduction. So I want to get your your take on the SALT deduction as well. So we got a lot to talk about. So 1202, if you're normally selling a business, by the way, let's say you sell that business for $2 million. What is the tax rate on a C Corp when they sell the business?
Well, so it's capital gains, right? So you're paying up to 20% is the normal rate. And then you've got the 3.8% net investment income tax. So that plus the state rate. So realistically, you're paying about 30% right now.
Okay. Yeah, and if you're in New Jersey with the 10.75, it's like 33.8.
Right.
It's crazy.
Right.
So Arizona, I heard, we're getting a little into state taxes. I heard Arizona did that. Arizona was getting higher taxes, and then didn't they just cut their state income tax?
They did. We had this horrible proposition that passed that increased tax rates by 80%, and then the governor and the Republican state Senate and state House, they went in and they didn't repeal it. What they did was they just brought the state tax rates down, back down to that 4.75%, 4.9%, something like that, and they're bringing them down even more. So on top of that, we just like you guys did, we enacted a entity level tax so that you could elect that and then deduct your state and local taxes. So about 20 states now have really you can deduct state and local taxes for a small business as long as you elect to be taxed at the entity level.
Well, that's huge because a lot of accountants were not talking about that with their clients. I heard about this sort of at the end of when I should have heard about it even myself. Talk about that. Those some of the programs I knew in New Jersey, they call it the BAIT, B-A-I-T. Can people go retroactively? So it was an interesting story, right? New Jersey passed a law. They said you can't do it past this date. And then the day taxes were due, October 15th, they for a lot of small businesses, they do extension, then they have October 15th. They open the window again, but nobody knew about it.
Interesting.
So it was like a weird thing. We had the help of some local people, and we called the state, and they opened it up. So
nice. So New Jersey, New York, the date was October 15th. They held fast on that, and then the date for 2022 is January. So you have to make the election in January of 2022, really at the beginning of the year, if you're going to pay that tax at the entity level in New York.
Yeah, so break that down a little bit more. So if I want this state income tax break because I'm not getting my state local tax deduction, you file at the entity level. They usually have websites.
You pay the tax.
You pay
the tax at the end. Right. So here's what happens. So normally an S corporation or partnership, that income flows through to your personal return, right? But obviously, if you pay state income tax on your personal return, you're not getting a deduction for that. That's not allowed anymore. What these laws allow is for you to actually pay the tax at this entity level, and the IRS has said if you have an entity level tax, then yes, you can deduct it. So it's just for your business income, of course. Doesn't affect your wages or any other kind of income, but it is a significant tax benefit.
And but it's due January of 2022?
You have to make the election. It's just when you make the election. So it's still not, the taxes aren't due, right, until basically April of 2023, but you have to make the election in January of 22. And if you don't make the election, you don't get to do it. So I think a lot of people are waiting to see what happens in this new bill. They're talking about putting a cap of $80,000 on the state and local tax deduction. So you'll love this, Josh. Because the state and local tax deduction is supposed to come back in 2026, what they've done is they said, we're going to put a cap on it to $80,000. We're going to extend that to 2031. And by doing that, it actually counts as a revenue raiser for them because they're actually capping it for those extra 5 years. It's so much smoke and mirrors, Josh. It's just hilarious.
It's a scam. That's what it is. So what's your take on the state and local tax deduction? Do you like it? I actually think that it may have cost President Trump the election. People underestimate the power of that deduction, particularly in areas that were swing states and even in regions. People love that state and local tax deduction. I know I did.
I know they do, but Josh, there's absolutely no policy basis for it. That's been on the chopping blocks for 40 years.
Yeah.
It was on the chopping blocks when I was in Washington, D.C. in the 80s. It was on the chopping block. So it was just always been an obvious one because, the states took away the deduction for federal taxes many, many years ago. There used to be a deduction on your state tax return for federal taxes paid. Frankly, there's no real good policy reason to allow it. And it does encourage the high tax states to, they say, well, look, you get a break. So it's not as expensive as it would be. And the people, frankly, it's being paid by those people who have a low state tax. So I don't know. I mean, from a policy standpoint, it's a tough argument from a policy standpoint. I get that it's popular, but remember also that we used to have the alternative minimum tax in 2017, and that went away in 2017. So a lot of people weren't getting the state and local tax deduction, even though it was allowed. The government giveth and the government taketh away, and the government gave the state and local tax deduction and took it back in the alternative minimum tax. And I just know multiple people in high-tax states that never got the state and local tax deduction because of the alternative minimum tax. Well, that's gone. So that means that if they bring it back, this is a deduction that a lot of people never got before, and they're going to get it for the first time.
Yeah, fantastic. We're with Tom Wheelwright, best-selling author of Tax-Free Wealth, which will be your free gift at 888-988-JOSH when you schedule and keep your no-obligation review. And you can go to wealthability.com. That's WEALTHABILITY, just wealthandability.com. And you can schedule a call with this team to learn how they can access the system for legally reducing their taxes no matter what happens in Washington. Or you could call our office at 888-988-JOSH, and we'll refer you to Tom and his team, which I can attest, they know their stuff. I mean, better than almost any people we have on in the country. Always love to hear Tom Wheelwright. I'm going to see did you recently have a Bitcoin conference? We're going to talk about his Bitcoin conference up next when we return. This is Josh Jelinski, the financial quarterback, and get the book, 888-988-JOSH, 888-988-5674. We'll be back after these messages. And we're back. This is Josh Jelinski, the financial quarterback. We're with Tom Wheelwright of wealthability.com. And folks, you can call our office at 888-988-JOSH, and you'll get a 2-for-1 special today. Tom's people will give you a free call, and you'll get a call with us, 45-minute year-end review, 888-988-JOSH, and you'll get the free book, Tax-Free Wealth. So it's near the end of the days. Great holiday present. There's no better holiday present, right, Tom, than saving on taxes.
Well, exactly. What's better than a tax refund? I mean, everybody loves a tax refund, and that's always my favorite time is when, April 15th comes along, and people have just been with us for the first year. They always get this huge tax refund, and they're just like, I can't believe I got such a big tax refund. I'm going, you know what? It's just a matter of understanding the law and applying it the way it's meant to be applied. That's all it is.
And we'll talk about that, kind of the big picture. We focused on some of these narrow things because of the tax bill. I do want to talk about your big picture planning items. You were recently a Bitcoin speaker? I forget. I saw something all over the web.
I was. Oh, yeah. I've actually, Bitcoin has been a big topic, and Bitcoin taxation. And there's actually some stuff in this new bill on taxation of Bitcoin. So there's a lot going on in the cryptocurrency world.
And I think that's one of the reasons why in the new bill, did they still get the money for all the IRS auditors?
They did. $80 billion is still in there.
Do you know how that's going to be funded? I'm theorizing that it's funding to do chain analysis on the blockchain so that they can figure out who owns what Bitcoin so they can tax the people. I think that would probably be the best investment for the government because of all these new Bitcoin millionaires and even Bitcoin billionaires. What say you on that?
Oh, I think they're definitely going after cryptocurrency transactions. There was the change in the infrastructure bill, then in this new bill, they're calling Bitcoin. They're treating the wash sale rules, like in stocks, right? If you sell a stock for a loss, you can't buy it back for 30 days, else you don't get the loss. They're going to do the same with Bitcoin and Ethereum, all the cryptocurrencies. So they're slowly trying to figure that out.
And when will that be effective,
I'm hoping that,
the wash sale rule?
That'll be effective January 1st. That'll be effective January 1st, 2022.
Wow.
So that's imminent. And I think that one will pass. I actually think it's probably it makes sense for that. I mean, it was a loophole for sure. And but I think that they're still trying to figure out. I think the IRS is still trying to figure out Bitcoin. I'm hoping that a lot of this money goes to technology and customer service, but I fear that it will just go to Commissioner Rettig's army of auditors.
Man, and so there's really not that much hope there. I was thinking it was going to go to upgrade their technology so they could go after tax cheats, or maybe
I would love that.
The new
that would be awesome
currency, because to me, I mean, I'm really down the rabbit hole with Bitcoin myself and learning so much. And, in some ways, I think the government will embrace cryptocurrency because it'll be easier to tax and regulate if they have an army of chain analysis people. But I don't know. Have you studied that at all or not really?
Well, yeah, we'll see. I mean, I do think they need to do a lot more. New York Department of Revenue does a pretty decent job of using AI and good data systems to help increase tax compliance. And the IRS has been way behind the eight ball on that. So I'm hopeful that they will do that. That would be a positive for everybody if they did that. We'll see. We'll see how far they can go after Bitcoin and cryptocurrency. It's more likely that the Fed will decide to do their own digital currency, which will allow them to basically spy on everybody. So that's kind of the whole point behind what China's doing with their digital currency is they're able to track people.
Oh, that sounds fun. And yeah, I just fear that all these new auditors are going to go after the little guy and the little...
They will. Well, here's an interesting one, though, Josh. So in the bill, it specifically says they're not supposed to go after anybody that makes under $400,000 or $450,000. It's in the bill. So I don't think they're going to go after those guys, but they're and frankly, that's where most of the tax cheating is. It's in the $100,000 to $300,000 range. That's my experience. It's not in rich people don't cheat because they don't have to. They can use the tax law to reduce their taxes legally. So I find that that's where most of the cheating is done, is in that $100,000 to $300,000 range. They're specifically not going after it, which means that, cheat away, I guess. I mean, I don't like it, but I think they're going to go after people who are using legitimate strategies, and they're going to argue just like they're doing now on things like captive insurance and conservation easements. They're going after these people, even though these are legitimate legal strategies that are clearly available in the law. And I think that's what they're going to do. But we'll see. We'll just have to see what happens if they get that $80 billion.
And yeah, we will talk all of those things: conservation easements, captive insurance, all that fun stuff. What the IRS might deem an abusive scheme. We'll talk about that next. And we'll talk about ways to reduce your taxes legally. So we'll get into some big picture year-end tax things. Where can our listeners learn things now to reduce their taxes for 2021 legally? So folks, you can do a couple things. One, you can get the book Tax-Free Wealth free when you schedule and keep your no obligation review. You can go to wealthability.com, talk to Tom Wheelwright's people. And if you call us today at 888-988-JOSH and request your free no obligation consultation, you get a 3-for-1 deal just in time for the holidays, Christmas and Hanukkah. You get the Tax-Free Wealth Book, you get the meeting with me, and you get a free call with one of Tom's people. But we need to hear from you now. 888-988-JOSH, 888-988-5674, 888-988-JOSH. We'll be back after these messages. And we're back. This is Josh Jelinski, the financial quarterback, with one of my all-time favorite guests, Tom Wheelwright. So we talked about the infrastructure bill. Anything we're missing on the infrastructure bill before we go to year-end tax planning?
Yeah, no, not really. That bill, of course, President Biden's going to is signing that imminently, and then the new bill should be going through Congress in the next couple of weeks. So we'll see what happens there. There is a lot that can be done between now and the year end, though, Josh. So I think that now is the time to really get your financial affairs in order.
So what are some tips, year-end tips for our listeners? What are some things they can do to mitigate taxes? Maybe they've had a good year and they're like, oh, I'm going to get killed in taxes. The time to plan is not April 15th. It's now. It's not October 15th. It's this next 6 to 8 weeks where people don't even want to plan. They want to enjoy the holidays. But what are some things people can do? First thing for everybody to remember is that the tax law is really a series of incentives. And so the way rich people legally reduce their taxes is they look for those incentives in things that they, are interested in. And it can be anything from investing in energy, investing in real estate, investing in their business. Typically what a lot of people will do at the year end is they're going, okay, what investments am I planning to make in my business next year? Let me just make them now and make those investments now. Because remember, you get 100% deduction for equipment. You get 100% deduction for actually a lot of the real estate. Really, there's just huge tax deductions in real estate. If you've ever thought, well, you know what, I'd really want to own my own building. Well, if you close on it by December 31st, you get a big tax break. So it's really most important, though, is to sit down with your CPA, really a good tax strategist who really understands these incentives, and look at, okay, what incentives am I going to be interested in? What incentives make financial sense for me? And let's get things done by the end of the year and get a big tax break. It's fantastic. So you mentioned business, real estate, and energy. Let's just go right down the list. Business. What should people maybe buy in their business? They got that. Do they still have that big 6,000 square foot tote, or the 6,000 pound towing capacity rule?
They do 6,000 pound SUV or truck. Yeah, that's 100% deductible. You have even passenger cars have pretty good tax deductions now. It's $18,000 the first year, so it's not too bad. There's any kind of equipment, any kind of supplies, for some small businesses, even inventory is deductible when they buy it. So there really are a lot of things that if you're planning on, don't spend money for taxes, right? That doesn't make any sense. But if you're planning on investing in the business next year and you're going, well, I can invest it in December, or I can invest it in January, March, or April, you might want to consider investing in December and getting tax deduction now instead of waiting to get the tax deduction next year. So business, pretty much any money you put back into your business is going to be deductible.
Now, what about the Section 179? Explain what that is. And are all of the rules with the Trump tax cuts still in place where you get like single first-year expensing and all that stuff?
Yeah, all those are in place. Nobody does 179 right now. It makes no sense to take a 179 deduction. That will make sense once the bonus depreciation, that first year depreciation starts to be phased out in 2023. But for this year and next year, there's really, I don't know anybody that takes a 179 deduction, Josh, because bonus depreciation gets you to the same place, and it actually has better rules.
So what can someone bonus depreciate this year? Like their copiers?
Any kind of equipment. copiers, furniture, like you said, a 6,000-pound truck. I mean, pretty much anything that you buy for your business is going to be deductible the day you buy it.
Fantastic. So you mentioned business. Then let's move over to energy. What can we do on the energy side of things?
Oh, my heavens. So there's a ton in energy. So oil and gas, still you get 80 to 100% of the money you put into to drill an oil well gets deducted in the first year. You can invest in solar panels. Solar panels, you get both a tax credit and a tax deduction if that goes on your business. So let's say you've got a building that your business is in, and you put solar panels on it, then you're going to get a 26% credit and you're going to get a deduction on top of that. So solar is huge. Any kind of alternative energy, as well as oil, even investing in coal has tax benefits. So energy is a very preferred way for that the government wants you to put your money into energy. As long as you do it the right way, there are huge tax deductions.
So I should consider solar for my house and my business, is what you're telling me.
You know, I'm a big fan. I have solar. In my business. I have solar on my house. It works well for me. Of course, I live in Arizona, so we get a lot of sunshine, and we have really high air conditioning bills in the summer. So I've run the numbers. For me, the numbers were amazing. They're really good return on investment. It depends on how much sunshine you get. Depends on how much you can actually get to use them. But when you're replacing your own utility bill, Josh, I find that most people, whenever they can use it for their own utility bill, so really the return on investment is the reduction in your utility bill. It can be pretty significant.
Yeah, if you're spending what is it usually cost for solar? I don't know. 30 grand.
House. And it depends. Right? You can spend anywhere from 30 to 100 grand on solar panels for a home or a business, and you're going to get a big credit. It's 26% this year, and then you're going to get if it's on your business, you also get a deduction. On your home, you don't get a deduction; you only get the credit. But if it's on a business, you get both the credit and a deduction.
And you have to take the business off the business piece of real estate or off the company.
So it's a deduction against your business income. So if you're an S corporation or a partnership, that deduction reduces your taxable income from your business. So and the credit comes really to you personally because it's going to flow through your business right to your personal tax return. It's pretty significant, Josh. I mean, I think people underestimate the power from a tax standpoint. The government's giving you about 60% of the cost if you put it on your business. You're only paying about 40% for that.
And you're getting a reduced bill for years, which is almost like an annuity.
Right.
I mean,
exactly. It is. It absolutely is. Solar panels now last a good 20 plus years. So it's a pretty good return. It's actually a pretty good return on investment when you consider you're only putting in 40% of it.
My problem is I get calls. Do you want free solar? Every day I get those phone calls. Do you get those on your phone? And they.
Oh yeah. I mean, I'll always do, but you have to do your research, find a good solar company, and have them do an estimate. I had one solar company came out to me and said, "Yeah, you're not. You're only using one office." I'm going, "Okay, well, it's COVID. That's why I'm only using one office." But in the next few months, everybody's coming back to work, so we got all the offices being used. Once everybody comes back to work, and we have huge utility bills. So, you just have to know you have to have a good company, just like any other. Good team members are always important in your investing.
Fantastic. Then you talked about real estate. Well, that might be a good time to pause for our next break. So, folks, give us a call, 888-988-JOSH. Final segment with Tom Wheelwright. You don't want to miss it. We're going to be talking about real estate tax breaks. Also, more things you could do by year end to save money. I'm going to look for some solar panels. I don't know about you. And I learn stuff from Tom every time he's on. And folks, give us a call, 888-988-JOSH, and get the 3-for-1 special. You get wealthability.com's Tom Wheelwright's team, free business call. Number 2, you get the tax-free wealth book, and you get a free call with us, 888-988-JOSH, 888-988-5674. And now, I mean, and we've called your office. They're very helpful. The Wealthability team is amazing. And now with Zoom, I mean, it used to be, okay, various people all over the country. Now with Zoom, it's very easy to do business with everybody all across the country. I think the one bright spot of COVID has been the barriers of business have been removed. And now with the power of Zoom, everybody's kind of in everybody else's living room. So folks, give us a call now, 888-988-JOSH, 888-988-5674. Up next, we'll talk about year-end tax breaks and real estate when we return. This is Josh Jelinski, the financial quarterback. Don't touch that dial. And we're back with Tom Wheelwright of Tax-Free Wealth, wealthability.com. His YouTubes, by the way, are fantastic. I watch every one that I can. And folks, hit the subscribe button on our YouTube channel. So you talked about real estate as a way to save taxes, but I've thought about this. If I want to save taxes, I have how many days? I got 30. I don't know. I got like 50 days to buy something. What do you buy, and what can you save money on with taxes by buying real estate? It is an up market, I guess, so that's a risk. But talk about real estate and tax breaks.
Well, so real estate's really the biggest tax incentive we have right now in the U.S., and that's because we have this bonus depreciation. And so typically, you're going to get a deduction the first year of somewhere between 20 and 30% of the purchase price of the real estate. So if you put 20% down, you're actually getting a tax deduction for more than you put down, because you also get a tax deduction for what the bank put in. So the numbers are pretty significant. It is kind of tight right now between now and the end of the year. But I got to tell you, if you find the right real estate and it works for you, I particularly like when people buy real estate for their business. I love that they don't have the limitations that the tax law puts on investors. Business owners get special tax breaks, and when they own their own real estate. So that's probably the easiest one. But again, you're right. You only have 50 or 60 days to go till the end of the year. It might be a little tough to close by the end of the year, but remember, you could close literally December 31st and get all the tax breaks as you would if you'd bought it on January 1st. So it's just a big number. And if it's something that you're interested in, something that makes sense for your portfolio, then you might want to look at something, but you want to look at it pretty quick now.
So, and that's the 20 to 30%. That's using something called like cost segregation, correct?
Correct. That's a combination. That means your cost segregation, and really it's important that you're using debt. Real estate doesn't make a lot of sense without debt. Because you leverage your tax benefits, you leverage your returns using debt, and interest rates are so cheap right now. They're so low right now. I don't know why anybody would pay cash for real estate. And the tax deductions are just so big because of the cost segregation and bonus depreciation. It's that combination.
Now, when you cost segregate, it has to be a business property, right? Unless you're an active real estate investor. Is that correct?
Right. So if you're an active real estate investor, then it can be any kind of rental property. If you're not an active real estate professional, if it's more casual, then it would have to be your business property. Correct.
And an active real estate investor, it's 750 hours for the year, or not more than 50%.
It's 750 hours and more than 50% of your time. So if you don't have any other business, then it can be you or your spouse. So let's say you've got a spouse that doesn't have another business activity, then 750 hours is all it takes for your spouse. But it does have to be more than 50% of the total business time that you spend in business on any kind of business.
No, fantastic. What about any other real estate tax breaks? I remember I think you were on a while. Isn't there some vacation home benefit?
Yeah, vacation homes get the same benefit, and vacation homes you don't have to be a real estate professional, so it actually takes less because it's not considered real estate rental. It's still real estate, but it's not considered real estate rental. So instead of 750 hours, it's only 500 hours, and it's really a combined 500 hours for all of your vacation home rentals. So, technically you could buy, even this late in the game, you could buy a couple of rental properties and you might be able to put those hours in. But certainly if you had some rental properties earlier in the year, vacation homes. But I think the most important thing right now, Josh, is sit down with your accountant, see where you are tax-wise, see if you need to do tax planning. Some people, may find that their income is low enough that they really don't need to do a lot of planning, and they might even want to accelerate some income this year if they had a tough year. See if they can actually bring some income in from next year into this year when the tax rates are lower than they will be next year. So that's one thing to consider. And the other thing to consider is really sitting down and really developing a plan of action that come January 1st, you'll see what you can do between now and the end of the year. But I'll tell you what, you sure want to be off and running January 1st for next year.
And that's a good point. A lot of people were they were thinking this major tax plan was going to change everything. And
right,
they were. I'm sure you face this. People were crazed about saving taxes the last 60 days, but now that the pressure's off, they can still procrastinate. Talk about why people shouldn't procrastinate.
Well, because every day you procrastinate is more taxes you're paying than you need to pay. And frankly, the fastest, easiest way to put money in your pocket is to reduce your taxes. It's just not that hard. We find that typically any entrepreneur, we can reduce their tax by 10 to 40% in the first 3 months. And it's permanent tax reduction, right? So it's not like putting money into an IRA or 401k. While that's good, that's temporary tax reduction, right? That's not permanent. Whereas some of these other types of strategies, they can be permanent tax reduction, but it does take a long-term plan with a very good CPA tax strategist that has a good system that they use, like the Wealthability system for reducing taxes.
Yeah, and I know you guys at Wealthability are very powerful in your knowledge base. And again, folks, our free offer today, call us 888-988-JOSH, and you get the 3-for-1 special. You get the meeting with the Wealthability team, meeting with my team, the financial quarterback, and the free book, Tax-Free Wealth, when you call us at 888-988-JOSH, or you can head over to wealthability.com. Just tell them you heard about it from here. Okay, so we've got 2 more minutes left. What are some other tax breaks that, as we round out, where should we focus the remainder of our time on?
One thing that I think people don't talk about as much as they should are the state tax credits. A lot of states have really nice tax credits for certain charities, for education, and you need to donate before the end of the year. So I think, we think a lot about charitable giving at the end of the year, and I think that's a really good thing because, of course, there are tax breaks for that. But a lot of states have, not only do they have deductions, but they have credits, which is a dollar-for-dollar offset. So I think that's one thing that's very commonly overlooked, and you can do a lot of good in the world and get some pretty good tax breaks while you're doing it.
Great. Tax credits. And final follow-up on the vacation home. The 500-hour plus thing, that is not the same as the active real estate rule where you have to be 50% more of your time. So if you have vacation homes, and there's another rule, right, where you can't stay in there longer than 30 days or something?
Right. You do have a 10% rule, so you can't actually use it yourself more than 10% of the time that it's rented. So if it rents for 300 days, you can stay in there 30 days. If it rents for 200 days, you can stay in there 20 days. So there are some, there's some other rules. There's always these little detailed rules, Josh, and that's why you have a good CPA.
Fantastic. So Tom Wheelwright, Tax-Free Wealth. So great to have you on again. And folks, give us a call, 888-988-JOSH, 888-988-JOSH. For the 3-for-1 special, head over to Tom's website, wealthability.com. Find out more about what they do. And they've offered a great promo. You get to schedule a call with his team and ours to learn how you can access a system for legally reducing your taxes no matter what happens. And that is a great way to end. You know, a lot of people were kind of waiting to last minute, doing their estate planning. You know what? I have to admit, I was doing my estate planning. And you know what I did? Even though they took the pressure off, you know what? I'm doing it. I'm just doing it this year because you're always busy if you own a business. And I love that point that you mentioned, why not just get some, repeat that again, the day that you wait is what? A day that you shouldn't have paid taxes?
Right. Every day you wait, you're paying taxes that you don't need to pay.
Every day you wait, you're paying taxes that you don't need to pay. So thank you so much, Tom Wheelwright. Always a pleasure. And parting 30-second thought. Go.
Thank you, Josh. I mean, what you're doing and the financial education, really the biggest problem in our country and the world today is the lack of financial education. So I really appreciate what you're doing. Thank you.
And always appreciate what you do. The Rich Dad Accountant, is that still your, are you still deemed the Rich Dad?
I am. I'm still a Rich Dad advisor. I am. I'm still, I can't seem to get out of it. No, I'm just kidding. I love it. I love the other advisors. I love working with Robert and Kim Kiyosaki, and it's a great privilege.
You know what's
to
crazy?
Be in their company.
I have our chief market strategist, who's from your neck of the woods. His name is Stan Harley. He did a video. I don't know if you've heard of Stan. He's our chief market strategist at the firm. He did a video. I'm going to go on YouTube right now and just look it up. He did a video with Robert, and they had something like 250,000 views.
Yeah.
And
they've got a big following.
So, it's amazing what they do and what you do. So, folks, give us a call, 888-988-JOSH. Head over to Wealthability, and you get the 3-for-1 special today, 888-988-JOSH. Thanks for joining us.
The preceding program was sponsored by the Jelensky Advisory Group.
Any awards, rankings, or recognition by unaffiliated third parties or publications, including 5-Star Wealth Manager, Advisory of the Year finalist by Senior Market Advisor, and top of the $1 Million Roundtable, are in no way indicative of the advisor's future performance or any individual client's investment success. No award, ranking, or recognition should be construed as a current or past endorsement of Josh Jelensky or Wealth Quarterback LLC. Information regarding specific awards, rankings, or recognitions is available on the Wealth Quarterback website at www.jelensky.org. All investment strategies have the potential for profit or loss. Investment strategies such as asset allocation, diversification, or rebalancing do not assure or guarantee better performance and cannot eliminate the risk of investment losses. There are no guarantees that a portfolio employing these or any other strategy will outperform a portfolio that does not engage in such strategies. This broadcast should not be construed by any client or prospective client as a solicitation to effect or attempt to effect transactions in securities or the rendering of personalized investment advice. Due to various factors, including changing market conditions, the information discussed in this broadcast may no longer be reflective of current positions or recommendations. While information presented is believed to be factual and up to date, Josh Jelensky and Wealth Quarterback do not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. The tax and estate planning information discussed is general in nature, is provided for informational purposes only, and should not be construed as legal or tax advice. Listeners should consult an attorney or tax professional regarding their specific legal or tax situation. Advisory services offered through Wealth Quarterback LLC.